In January 2008, Bank of America's CEO stood before cameras and called it a great opportunity. He was acquiring the single most toxic mortgage lender in American history for $4.1 billion. His board approved it unanimously. Of course they did. By the time the bill came due, that great opportunity had cost Bank of America an estimated $40 billion in settlements, fines, and legal fees. That is roughly 10 times the purchase price. Paid to make the lawsuit stop. This is not a story about bad luck. This is a story about a company that ignored every warning sign, every red flag, and every analyst who had the nerve to say what the numbers already showed. Bank of America in the early 2000s was a genuine American titan. Founded in San Francisco in 1904 as Bank of Italy. Yes, Italy. It had spent a century becoming one of the largest financial institutions on the planet. By 2007, it held assets of approximately $1.7 trillion. It had 200,000 employees. It served 1 in 2 American households. It was, by any reasonable measure, a success story. Ken Lewis had been CEO since 2001. He was aggressive, acquisitive, and deeply convinced that size was strategy. He had already absorbed Fleet Boston for $47 billion in 2004 and MBNA, the credit card giant, for $35 billion in 2005. The man liked a deal. He was named CEO of the Year by Bankrupt Sorry Banker magazine in 2008. Remember that. Now, Countrywide Financial. Founded in 1969 by Angelo Mazzillo, a tanner's son from the Bronx who built the largest mortgage lender in the United States through sheer relentless aggression and a near-religious belief that everyone deserved a home loan. Everyone. By 2006, Countrywide was originating roughly 1 in 5 mortgages in America. 1 in 5. Its loan volume exceeded $460 billion that year. Mazzillo was on magazine covers. He was celebrated. He was, reportedly, earning over $100 million a year. He was also, quietly, selling his own company's stock. Between 2006 and 2007, Mazzillo sold an estimated $140 million worth of Countrywide shares through prearranged trading plans. He knew something. The market would find out later, because what Countrywide had actually built was a machine for issuing loans that could not be repaid. Subprime mortgages. Adjustable rate loans with teaser rates. Ninja loans, no income, no job, no assets. They issued those, proudly. Their market research said customers wanted these products. Their customers, it turned out, wanted to afford their houses. These are different things. By mid-2007, the cracks were visible to anyone willing to look. Delinquency rates on Countrywide loans were climbing. The housing market was softening. Bear Stearns had already imploded 2 hedge funds stuffed with mortgage-backed securities. The dominoes were falling. In August 2007, Countrywide drew down its entire $11.5 billion credit line in a single day. That is not a company managing a rough quarter. That is a company running out of runway. Bank of America injected $2 billion into Countrywide in August 2007, a strategic investment, they called it. This was the first mistake. The second mistake was deciding that, having invested $2 billion, they should simply buy the rest. On January 11, 2008, Bank of America announced it would acquire Countrywide Financial for approximately $4.1 billion in an all-stock deal. This valued Countrywide at roughly $7.16 per share. 18 months earlier, the stock had been at $45. That should have been a clue. The deal closed in July 2008. 4 months later, Lehman Brothers collapsed and the entire global financial system discovered exactly what a portfolio of fraudulent mortgages was worth. The answer, broadly, was not much. What Bank of America had purchased for $4.1 billion was not just a mortgage lender. It was a legal liability of staggering, almost incomprehensible scale. Countrywide's loans were defective, systematically, deliberately, and now they were Bank of America's problem. The lawsuits began immediately. federal regulators, state attorneys general, investors who had bought mortgage-backed securities stuffed with Countrywide loans, the Department of Justice. They all had questions. Bank of America had very expensive answers. In 2011, Bank of America agreed to pay $8.5 billion to settle claims from institutional investors over faulty mortgage securities. It was, at the time, one of the largest such settlements in history. It was not the last. In 2013, the Department of Justice filed a civil fraud lawsuit over Countrywide's Hustle program, formerly named the High-Speed Swim Lane, which had been designed to process loans as fast as possible while eliminating quality controls. The name was real. The fraud was real. In 2014, Bank of America reached what was then the largest Department of Justice settlement in American corporate history, $16.65 billion. For one acquisition of a company they paid $4 billion for. Total estimated cost to Bank of America from the Countrywide acquisition, across all settlements, write-downs, and legal expenses, north of $40 billion by most analyst estimates. Some put the figure closer to $50 billion when all costs are included. Bank of America's stock price, which sat around $45 in early 2007, had collapsed to below $5 by early 2009. The company required $45 billion in government bailout funds under TARP. It was briefly a genuine question whether the bank would survive. Ken Lewis resigned as CEO in December 2009, under pressure from shareholders and regulators. He left with a pension reportedly worth around $53 million. He did not return the CEO of the Year award. Angelo Mazzillo, for his part, settled SEC fraud and insider trading charges in 2010 for $67.5 million without admitting wrongdoing. He did not go to prison. He reportedly lived comfortably in retirement. The loans he issued did not retire comfortably. Hundreds of thousands of American families lost their homes to foreclosure on mortgages that Countrywide had issued and Bank of America then serviced. In 2012, Bank of America paid $335 million to settle claims it had discriminated against Black and Hispanic borrowers in Countrywide's lending practices. It kept settling. So what actually went wrong, beyond the obvious answer of everything? Due diligence. Or rather, the catastrophic absence of it. Internal Bank of America memos that later surfaced in litigation suggested that analysts inside the bank had flagged serious concerns about Countrywide's loan quality before the deal closed. Those concerns were, apparently, not sufficiently persuasive to the people making the decision, because the people making the decision had already decided. That is how it works. Data does not stop a committed executive. Data just becomes an inconvenience. Here is the lesson. When a company is collapsing, its price is not a discount. It is a signal. Countrywide was cheap because it was damaged. Bank of America mistook distress for opportunity, bought the liability along with the assets, and spent the next decade paying for the privilege. Price is not value. A burning building does not become a bargain just because the owner drops the asking price. And sometimes, the smartest deal you will ever make is the one you walk away from. If you want to know what happens when a company does not walk away, when it doubles down on a disaster in real time and somehow makes it worse, the story of AOL Time Warner is waiting for you. Subscribe for more hidden empires.